Hello, everyone. Welcome back to the Trading Club Q7U. I'm your lead educator, and today we're going to tackle one of the most daunting aspects of trading for beginners: stocks, forex, crypto, commodities, and indices explained. For many, these words might sound like a mysterious language, especially if you've never traded before. That's why we're starting from first principles, and by the end of this lesson, you'll understand what each one is, why it matters, how it works, and what common mistakes beginners make. Let's begin with stocks. Stocks, also known as equities, represent ownership in companies. Think of it like buying a slice of a pizza. When you buy a stock, you're essentially buying a tiny piece of that company. As the company grows, your slice of the pizza might be worth more money. But if the company struggles, your slice might be worth less. The price of a stock is determined by supply and demand, just like a restaurant's pizzas. For example, let's say you buy 100 shares of a company called ABC Inc. for 50 each. In theory, if ABC Inc. goes public with a successful IPO, the demand for its stock might increase, driving the price up to 75 per share. You can then sell your shares for a profit. But if the company underperforms, the demand for its stock might decrease, driving the price down to 25 per share. You might lose money if you sell at a loss. Now, let's move on to forex. Forex stands for foreign exchange. It's the trading of currencies, which might seem complex, but it's actually quite straightforward. Imagine a trip to a foreign country, where you need to exchange your local currency for the local currency so you can buy souvenirs or pay for travel expenses. The same concept applies to forex trading. You're essentially trading one currency for another, hoping to profit from the difference in exchange rates. For example, let's say you think the US dollar is weakening against the euro. You can buy euros when they're relatively cheap, and sell them when they're strong, earning a profit from the difference in exchange rates. Next up is crypto. Cryptocurrencies are digital or virtual currencies that use cryptography for secure financial transactions. Think of it like the difference between cash and a credit card. Cash is physical and traditional, while crypto is digital and newfangled. Crypto prices can be highly volatile, so it's essential to understand the risks before diving in. Let's say you buy 100 units of Bitcoin, and its price drops drastically. You might lose a significant amount of money, but you can also try to sell during a market correction and buy back at a lower price. Crypto is known for its significant price swings, so it's crucial to stay up to date with market news and analysis. Commodities refer to goods that can be bought and sold, such as oil, gold, or coffee. These markets are influenced by supply and demand, just like stocks or forex, but the products themselves have physical properties and uses. For example, the price of oil can increase due to a supply shortage or strong demand from other countries. You can buy oil futures to profit from the expected price increase, and then sell them when the price reaches its peak. Last but not least, indices represent a group of stocks that share similar characteristics. Think of it like a portfolio of investments that mirror a particular market, sector, or region. These indices can give you a broader view of the market, or help you identify specific trends within a sector. For instance, the Dow Jones Industrial Average is an index that represents the performance of 30 blue-chip companies in the US. You can buy a futures contract on this index to profit from the collective performance of these companies. Now that we've covered stocks, forex, crypto, commodities, and indices, let's talk about what mistakes beginners make and how to avoid them. One common mistake is to trade without a solid understanding of each instrument and the underlying market. Make sure you understand what you're trading before you trade it. For example, a beginner might buy a stock without researching its financial performance, management team, or industry trends. When the stock price drops sharply, the beginner might panic and sell at a loss. This is why it's crucial to understand the market fundamentals before making a trade. Another mistake is to over-leverage your trading account, which can lead to significant losses. Always start with a solid risk management plan, and use stop-loss orders to limit your exposure. For instance, if you want to trade 1,000 worth of stocks, but only have a risk tolerance of 200, you can implement a stop-loss order to close your position when the stock price drops to a certain level. Lastly, never promise yourself guaranteed profits in trading, because there are no guarantees. Trading involves risk, and you must be prepared to lose some money along the way. Don't get discouraged by small losses, or view trading as a way to get rich quick.